Good day and welcome to yet another weekly wrap from Brand Swiss. So we've been away for a couple of weeks, but we are back and we're hoping to get back on a regular schedule once a week. So this week we can discuss a couple of things out there and do a deep dive into the Chinese situation. We're going to start off with basically looking at what is happening with reserve banks. So the SARB has come out and warned about a price spiral in South Africa. We've also seen the US Fed come out and talk about the fact that they need to continue raising interest rates, even though it might be at a slower pace than had been forecast. And also we've seen Ghana in West Africa come out with a 3% rate hike because of a rapidly declining currency. All these factors together make me believe that we are still in the midst of a rate hiking cycle, and that means that we are very unlikely to have been past the bottom of this market at the moment. I think there's only been one period where the US was in the rate hiking cycle and basically markets rose from there or already had seen the bottom from that point. That was, I think, in the mid to late 80s. And at that point, we're talking about P ratios that were around 10 or so. And we're talking about, forward earnings that are looking incredibly strong. None of those things apply at the moment. So it'd be quite unusual for us to have seen the low of the market at the moment, given the fact that we are still going to be seeing significant rate hikes from here, and we don't know when that rate hikes will end. Next, the Eurozone. Europe basically continues to be buying natural gas at quite an alarming rate. I think we need to consider the fact that Europe is likely to come out of this winter, depending on a couple of factors, which I'll discuss in a second, without too much in terms of serious blackouts and real energy shortages, but with a significant impact on both industrial output and consumer spending and consumer demand. We have seen a significant increase in the price that consumers are spending in Europe at the moment with regards to energy consumption. I think the estimate for the UK is to have almost a doubling of energy spend from about £1,600 to about £3,200. This is quite interesting because apparently, according to a recent survey, about 1 in 8 UK consumers believe that actually be a drop in prices coming this winter. It's quite a big mismatch between what they believe will happen and what experts are forecasting for that period. We are seeing possibility of rationing, especially to industrial users in Germany, in places like, for instance, France, etc. France, by the way, at the moment has an issue with regards to its nuclear power plants, where they cannot operate at full capacity because of an issue with the fact that they can't get enough cool water. They've been using, general water from nature, and the heat wave has made that too hot to be, really usable for their nuclear power plants at the moment. So that's a big issue. But looking at the rest of Europe at the moment, we have 3 factors that is going to affect what Europe is going to go through this winter. The first is, will Russia totally cut off supply? Russia at the moment has cut down supply significantly, but it's not zero. If they cut off supply entirely, there's an issue. The next is, how cold will winter be? We don't know what the weather situation in the next 4 months is going to be like. Our forecasting is not that accurate at the moment. But if winter is going to be as mild as it was last year, it's probably going to be okay. If it's a cold winter, there's probably not enough supply in Europe at the moment. And finally is, how much are consumers and industry going to reduce demand because of higher prices? And that's already starting to happen at the moment. We already are seeing industry and consumers really buckling under the pressure of this price increases. And like I said, we're expecting much more in terms of price increases going into this winter than have already occurred. Now, what is the impact of this situation on the rest of the world? Europe, because it's wealthy. Look, the average European is very wealthy compared to the average person in the world. To give an example, that number I gave you for the energy consumption in the UK of about 1.6 thousand pounds, £1,600 basically a year, is roughly equivalent to what the per capita GDP is of India. So the average Indian makes about that amount of money a year. And obviously, if the guy in the UK wants to spend more to get more natural gas, more energy, the guy in India can't compete because literally there's not enough money to do that. So we're seeing places like Bangladesh, Egypt, Pakistan, all basically having some kind of rolling blackouts. And as we go into winter, if Europe continues to demand at the kind of level it is right now, we could see significant, energy constraints in the rest of the world. So effectively, Europe would be kind of exporting its blackouts. So they might avoid blackouts in Europe, but it'd be exported to parts of the developing world. Now, the final thing I want to talk about this week is China. And I want to go into a bit of a deep dive as to what's happening in China and to give an idea as to why things are serious. So, a little bit of background. The Chinese economy is a little strange because it's a bit of a closed economy in terms of investment. So it's very difficult for an average Chinese person to invest out of the country. So they have left a couple of options. What do they put their money into? One is the stock market and one is the real estate market. Now the stock market has gone through a boom and bust period, kind of scaring investors. In addition to that, the Chinese consumer is a bit more conservative when it comes to stocks, etc. So they tend to prefer to invest in physical assets like real estate. So at the moment, the Chinese real estate market is a massive store of wealth. So in terms of the total amount of wealth stored in the US economy, in real estate, it's about 35-40% or so of the total market. In China, it's closer to basically 65-70%, almost double of what the Americans basically are storing in the real estate market. So China's are storing twice as much wealth in real estate as the Americans are. Real estate is about 30% of the total GDP of China, huge chunk of the Chinese GDP. And the Chinese also have a weird system in terms of how basically people buy real estate, because real estate is an investment, so people are willing to put a lot more money than you'd expect into a real estate investment. And sometimes people are willing to put as much as half of their income into a mortgage. They're looking for any kind of advantage they can in terms of how to basically reduce that payment. And one of the ways that's been really popular in China, and we're talking about 80-90% of all like real estate transactions in the retail sector are currently like this, is to basically pay up front for a property before it's even been built. So what a developer does is makes a plan out, I'm going to build this block of flats. You can buy your flat right now, pay me up front, and when it's delivered, you get your flat. So what happens is the guy goes off, gets a mortgage, the real estate guy gets his money, you pay off your mortgage before the flat is even built. Now what's happened over the last year or so is that there's been a bit of a crunch in terms of the ability of developers to access funds. Why? The Chinese government went through a reform where they basically put some red lines in place in terms of how they are going to allow real estate companies, developers to go and basically finance themselves. And if you basically breached certain limits, you were not able to borrow as much money as you were in the past, all the way to breaching the third limit, and you couldn't borrow any money at all. That was what happened to Evergrande, by the way. Evergrande is a big developer that just collapsed recently. So what happens is that these developers are unable to access funds to develop their properties. So what they are doing at the moment is that they are taking money from new investors and using it to basically try and help older investors. That's kind of like a Ponzi scheme where you take money from the new guys to basically bail out the old guys. That is something I think that we all know how that ends eventually, that these Ponzi schemes collapse. The Chinese real estate sector is entering that kind of period. These mortgage payers, the people that are paying the mortgage, that have borrowed money to basically go and build these, to buy these houses that have not been built, or apartments that have not been built, they are realizing that their apartments are not being built and may never be built because the developer might go bankrupt, the developer doesn't have the money to do that, the developer is basically more focused on getting new clients in as opposed to basically satisfying the needs of the older clients, because they can't basically do or fulfill their obligations with the funds they have available. They need to get new money in to make their system work. If you're in that situation where you're spending maybe half your income on a mortgage on a property that you may never receive, what would you do? You'd stop paying the mortgage. That's what they're doing in China at the moment. There's a mortgage boycott. Now what happens to the mortgage boycott is that you don't pay a mortgage because your mortgage bill, because you don't think you're going to get the property at the end of the day. Unfortunately, what that also does is it makes the bank that basically lent you the money effectively very vulnerable. And that's why we are seeing these banks under stress in China at the moment. So what we have at the moment in China is a real estate sector that's 30% of the economy, basically in a bit of a downward spiral. We have millions of people that are paying mortgages that they don't, or they're likely not to get the outcome from that mortgage, the property developed to them. And then we have banks, which basically have lent out billions and billions to these developers and expected citizens to pay these mortgages, possibly not getting that money back. And of course, what happens then is the people that have money at those banks are then going to be penalized because those banks might go under and then their money goes away. There's a limit to how much China guarantees in terms of the amount of money that you can have in a Chinese bank that will basically be guaranteed in case the bank fails. And most people, but a lot of people have more than that. So if those banks fail, that money disappears. And that is the kind of crisis that they're having in China at the moment. At the same time, we've seen, of course, the COVID lockdowns, which, in my opinion, that makes no sense. GDP growth has been downgraded for China. I think the latest one I saw was just about the mid 2% to 2.5% or so. And the unemployment rate among youth in China is extremely higher, over 20%. At the time that we are seeing Xi Jinping go in front of the Communist Party meeting in a little while and try and get an unprecedented third term for himself. So China at the moment is in a very dire situation. And we could easily see quite a big change happening there in terms of growth prospects, in terms of political stability, in terms of protests. So China right now is, like I said, a bit of a powder keg, and it's worth keeping an eye out at the moment. Okay, on that depressing news, that's my wrap for the week, and I look forward to speaking to you guys again next week. Cheers.